volatility perspective, we really shifted regimes, and now we're in a higher volatility So moving on to the next slide, no major changes here. Again, this really kind of shows how the portfolio is positioned from an up or down market capture perspective. And then on the bottom of the chart, how we react during drawdowns. We've talked about this a lot in the past, how our portfolio conservative positioning, we perform well in drawdowns in comparison to both our benchmarks as well as the equity markets, which is what you see there on the bottom right, specifically the latest drawdown that we saw mainly throughout 2022. The orange there being the pension plan, you can see how that portfolio performed better than all of the comparisons here, which is kind of how we position that, and then we like to see that over time. Slide 19 shows our performance versus our peer group, which is the public funds greater than 20 billion. And again, lower risk profile, which you see on the bottom, the percentile rank on a risk perspective, we are certainly below median, and typically over the longer term, really the bottom quartile, and even in some perspectives, the bottom decile here. So much lower risk than a lot of our peers, which leads to lower returns over time as well. And you can see in the 1 year, we're a little bit below median, and a little bit pretty much in the bottom quartile for the other time periods as well. Now, on the next slide, the Sharpe ratio, which is really a measure of risk-adjusted return. It takes into account both the returns and the risk. You can see how we fare fairly well over time on this. Shorter time periods, a little bit less so, and then the below median for the 1, 3, and 5 year. But you can see 10, 15, and 20 year, we're above median and closer to top quartile in some time periods. Looking at liquidity profile, again, this doesn't change dramatically from quarter to quarter. The left side shows the liquidity allocation in dollars. The right side shows it in percentages. So you can see, we like to maintain by policy a level 1 liquidity, which is really extremely liquid T+3 type settlement. We like to maintain at least 70% of the plan in that by policy. And as of the end of June, we were at about 76% level 1, which is significant liquidity for any of our cash needs. Slide 22 shows our net benefit payments by calendar year. So this is the net amount that is pulled out of the investment portfolio by year. So you can see it's still at about $2 billion annually that gets pulled out. The way it works is it gets monthly drawdowns. It gets taken out of the portfolio, so we have to anticipate that. We have to plan for that. We need to make sure there's enough liquidity in the portfolio to fund that. And like I said, it's come down slightly over the last several years, but it's still at roughly $2 billion per year. And as a percent of the portfolio, which is one of the metrics we try to monitor closely, we want to make sure we're, below 3% is really the target. And you can see that dotted line's the 3%, the solid orange line is our actual, and you can see how that's come down pretty significantly in the last several years, and it's below 2% of the market value of the portfolio, which is very good. Then the next slide is our alternatives liquidity profile. So we've seen this shift a bit over the last year or so, and really over the last few quarters, where we are less net cash flow positive than we had been over a number of years. If you looked at this over the last couple of quarters, we had a net cash flow for this 12-month period that this measures of over $1 billion. If you look at the top right here, the net cash flow for the previous 12 months is at about $560 million. So we have seen the net cash flow go down. A couple of reasons for that. We have seen less distributions coming back from some of our managers from a lot of distributions that we saw in 21 and 22 into 22. But we've also seen some cash flow go out, so some bigger capital calls of some of our investments that we made. So we've seen that shift slightly. We still see more money coming in that's going out, but that has drifted down a bit over the last couple of quarters. And then the next slide shows how the portfolio is valued and kind of the profile, the lag profile of this. Some of our assets aren't marked to market every day. Some of our assets are marked quarterly, some are marked monthly. This kind of shows how the portfolio is marked and how we should think about that as we're looking at all these metrics and all of our performance, right? So you can see by asset class at the top, the blue is basically valued daily. The orange and the gray are monthly, and then the yellow there is quarterly valued. So you can see that about 75% of the portfolio is marked daily, and then another 9-ish or so is marked monthly. So well over 80% of the portfolio is marked at least monthly, and then the other 16% or so is marked quarterly. So with that, I'll pass it back over to Jeff to the asset class performance.
On slide 25, the asset class net fees performance. Looking over the 1 year column, strongest performers, public equity, as we've touched on, 16.7%, really strong 1 year number there. Inflation sensitive as well, strong and multi-strat. And then on the weaker end of things for the year, non-core real estate, as well as core real estate, the weaker on a 1 year, as well as the IG fixed is slightly negative. What we talked about what happened with rates, and then private equity there down 6%. And we talked about the timing part that comes into some of these 1 year numbers. Chris touched on that earlier. And you look across the longer periods, especially directly looking at private and public equity markets, you kind of see that settle itself out and performance. So not uncommon to see those 1 year differences as there's valuation lags. On slide 26, taking a look at the diversification across time periods by calendar year periods. For the first half of 23, again, the standout performer up top right in the dark blue there, public equities, inflation up there as well too, which we've talked about in the past meetings. Really, you see those up there in the last couple of years. When we've seen inflation, we've seen that portfolio be one of the stronger performers, which is good. And then on the bottom right, we talked about the real estate stuff valuation there, having a tough start to the calendar year. So moving on to slide 27, our new and incremental and unfunded commitments. On the left side of the page here, anything new? We had 2 new things in private equity. I know they're presenting later. Maybe Greg will touch on those at that point. That were in July, as well as Magnetar on the inflation side that was in June. So those are the only 3 things since the last time we sat down. On the right, which is the unfunded commitments, when we sat down last time, that was just over $7 billion. We're at 6.876 here, so down about 150 from when we talked last time. I think the only notable one there probably is private. Most of that was in private equity, but this is as of June 30 here. You see on the left that we had these new things that were in July, so really we're kind of where we were when we sat down last meeting. On the next page, on slide 28, historical numbers here on where we are on total unfunded. And you can see 6.8 that we mentioned on the last page, and that represents as a percentage of the market value there, 5.90%. That number was 6.2% when we sat down last time. Nothing really new on 29. That's kind of just what it is there. On page 30, exited investments, we have nothing new to report since the last meeting. And then finally on slide 31, our top 20 investment managers. Up top on the internal piece, the internal fixed income piece is a little lower, really due to the performance in that area and strong performance in internal equities. As such, the internal equity number is up 1% from where we were last year, or last meeting. And then all the way down, no real changes on the names on the list there for the top 20, with the exception at the very bottom. I think Rockpoint was on this list last time, and Marathon Asset Management there at number 20 is the change with Rockpoint out. So nothing material there. That's it. Any questions on the performance deck?
All right, thank you very much. We'll move to the private equity asset class.
All right, good morning, everyone. Before we get started, you'll notice there's a new addition to the table with us. To my left, Sean Braswell joined us this past May, recent graduate from UNC Keenan-Flagler. He had some prior experience for business school and welcome addition, joined us as an analyst, and first day was May 1st, so pleasure to have him aboard now. So our first page, normal review of our allocation. Well, we are within our statutory bands. If you recall, the legislative cap for private equity is also grouped in together with multi-strat, and it cannot exceed 8.75%. Combined, the two are about 7.5%. And in terms of private equity, as of June, we are at 5.4%, below our policy target of 7%, but we are making new commitments and hope to make that differential less over the coming year. Next page. We've used private equity composition in terms of the strategies. Remember that we are ourselves a fund of funds the way you would look at it. So what we do is we take our fund-to-fund commitments and look at the underlying strategies and divvy them up amongst the three major sub-strategies, which would be buyout, special situations, and growth venture. We are within all of our March 31st, we're using March 31st because that's the last time we got official valuations for the entire portfolio. If we look at June, it would just be cash flow adjusted. So looking at March and comparing that to our ranges, we are in our policy targets with all three asset classes. Next page, Sean.
I'll briefly be discussing the exposure across our allocation. We're very diversified. As you see, what stands out is about 24% in information technology, which sort of goes hand in hand with the S&P, which sits about 25.9% out of 100. Also, a very close comparison is healthcare. We're at 13.3, while the S&P is at 12.8. This is as of March 31st. And also, you see our exposure on the geographic allocation side, about under 75, about 3/4 of North America, a little less than 20% in Europe, and 6.6 in Asia.
Those aren't large differentials in terms of geographic exposure from last year, and they've been fairly consistent over the last few years. In terms of the industries, we don't manage to target allocations in industries. We just monitor them to make sure we're not over allocated to any one. And really, as Sean pointed out, the IT space jumped off the page to us at about 1/4 of what our exposure is. That still is below the S&P exposure. Next page. So performance. Again, as of March 31st, that's the latest we have available underlying NAVs from our managers. I'll walk through since inception to kind of so everyone understands these numbers again. So we made since inception 155 fund commitments. The amount of capital that has been called is slightly less than $11.8 billion. The amount of money that has come back to us is almost 13.3 billion. That DPI number is simply taking the amount that we had distributed and dividing it by the called capital. So for every dollar that went to a manager, we got $1.13 back. That's 1.13x. However, there's a residual value. Obviously, we have a capital account balance with these managers still, which is slightly less than $6.2 billion. If you were to add up the distributed capital, 13.3, plus the residual, 6.2, you would get to that 19.5 billion total value, which equates to a total value to paid in, that TVPI number, of 1.65, which means for every dollar we committed, we have created value of 1.65 or 65 cents on the dollar is our profit. In dollar terms, that equates to approximately $7.7 billion since inception. And the IRR since inception is 10.2%. So what we like to do is compare ourselves to what would have been in the public markets. And there's a standard standard analysis that is run by Kaplan and Shore. It's called the public market equivalent. And we can choose an indice and run it against our portfolio versus the public portfolio. If the number was one to one, that means we did not outperform the public markets. If it was less than one, we underperformed, and above one, it's greater. As you can see, we're about at one for the S&P and the Russell, and the MSCI were a little bit above at about 1.07. However, it's a tale of two worlds. We spoke about this in the past. Things that were done prior to 2010 did not perform well because there was a heavy reliance at that time on fund of funds. Plus, we did a very large secondary. It equated to almost a quarter of our exposure from earlier vintages. That was done in the 2010 timeframe, and that crushed that performance. We were a seller. We did a secondary. We were a seller. We sold at the wrong time in the market, but it was kind of forced because we were over allocated. So those earlier vintages did not perform well. If you look at things that were done in 2010 on the far right column, it's the tale of two cities. The IRR jumps up to the most recent vintages or that time period to 16%. And if you look at the public market equivalent numbers below, they're all nicely above 1.1. In the case of MSCI All World, it's 1.2. So the later performance has really helped out.
And that's during arguably one of the longest and strongest public equity markets. So private equity still outperformed in a really favorable environment for public equities.
Next page. We're on page 6 for you, those of you who are on the monitor. So this is our time-weighted performance, and we have this through June. Because it's the most recent available for the entire portfolio as a whole, meaning the total pension plan. And obviously our numbers, again, are still cash flow adjusted from March. However, just looking at this, you can see the June 23, the 3-month performance of 1.82%. We've turned a corner. We definitely had a difficulty in our portfolio. It was down last year as a whole. But it seems that things are starting to right themselves in the first quarter of this year, which is what we see in the second quarter, the June number, our overall June number. And indications are going forward, we're going to still continue to see more improvement. But again, we did miss the 1-year benchmark. We were down 6.7% versus the benchmark being down 2.5%. We've said this in the past, and I'd say it again. We'd argue that our managers are more conservative in terms of their marks. How do we know that? There's one number that jumps off the page, and that would be from June 2021. If you look at that 1-year performance, we're up 58% versus the benchmark being up 46, 45, 46. Why I'm singling out that 1-year time frame, there were more realizations in that 1-year period than any other year historically. I'll show a later chart, but it just jumps off the page. Not just us, but the industry. And there's no more marking your portfolio. When you sell it, that's what the mark is. And we have continuously seen when our portfolio has been realized, we're getting meaningful increases to the value versus what it was held at in the preceding quarter. And it adds up over time. So as realizations start to come back into the market, I think we're going to see even more dramatic outperformance. But for the past fiscal year, our weakest areas were twofold: fund of funds, as well as venture capital / growth equity. Fund of funds speak for themselves, but in terms of venture capital and growth equity, that was actually our strongest area in pre-seed. A lot of the high flyers that really jumped off the page in terms of performance retraced themselves to a degree. So they were definitely down over the fiscal year.
How many billions do we have left in fund of funds?
Not a billion. It's about 670 million.
These are things that preceded me,
Correct.
and we're just winding them down as we can.
Correct.
Is the whole industry collapsing fund of funds?
No,
Generally?
because it makes a lot of sense for groups that are very small endowments. It's more expensive to them, but over the long run, it still outperforms, from what I've seen, public markets.
Okay, thank you.
Funds of funds have shifted also to SFOs. So rather than a commingled big fund of fund, the managers have realized that LPs want more specific mandates, so they'll come in and create individual structures for them.
So interesting side note, I was speaking to one of our venture capital managers, and they had some frustration because they didn't understand how their portfolio was so dramatically different than the benchmark. They were underperforming. And in speaking with them, they're under the assumption that they are being conservative versus a lot of their peers who are holding things flat still. They did not take those marks that otherwise, we're probably going to see more outperformance versus the benchmark in our venture capital area, simply because we're going to be riding things back up, whereas others are holding them flat because they never wrote them down.
Ma'am,
Excuse me.
tell her we're always more interested in the cries of a child than the snores of the audience. So that doesn't bother us. Go ahead.
Is there any merit to having multiple benchmarks? Or are there other benchmarks for private equity?
There are. I mean, we use a benchmark from Burgess,
Right.
created our own based on our allocation, but off of their figures. There's others out there. There's one from Cambridge. We looked at it years ago. Why we didn't use it? It seemed that it was more heavily, it had a lot more venture funds included in it than we would ever be able to get access to.
Right.
It would skew it in a manner that it wouldn't make sense for us. That could change. We should probably explore at some point in time. Even our current benchmark we want to explore, because our special situations, there's no such thing as a special situations benchmark. Our special situations is co-investments, secondaries, and distressed for control. But the entire benchmark, the closest thing we can get in Burgess is distressed.
Right.
And the current benchmark has a 30% weighting in distressed. There's no way you can get that allocation in private equity to it. So in a down market, distress is going to outperform, so we'll underperform.
Right.
But we actually probably look better over the long haul when distress is underperforming.
It seemed that in the past, when we put it together, the distressed index or distressed performance kind of mirrored secondaries, which we have a large exposure to. I don't want to say mirrored, but
Right.
they were relatively comparable. Now, with the markets being a little bit more down, weak, stress is actually going to perform a lot better.
Well, you've almost created a fund of funds within the treasurer's office. You could almost compare to other fund of funds to see that performance.
It's true, but I don't know if there's truly a fund of funds. Matt, do you remember? Is there a fund of funds figure, for benchmark?
There could be a period worse.
Could be, okay.
Well, every investment manager is going to create a portfolio, and a fund of funds just has a different fee structure to it than ours. So, yeah, when we're trying to compare ourselves to top quartile performance within private equity. And fund of funds might naturally lean towards median because if they have to invest and diversify and do certain things, it doesn't give them the flexibility to scale into the better performing GPs.
Mike Mevin may have joined us, so I'd like the minutes. Go ahead.
Slide 7. So this slide highlights the performance and deployment of the co-investment program through March 30th. And the co-investments have resided in 2 series or structures, NCL2 and NCL3. And the top part shows what we've deployed and what the returns are. So NCL2 was the first iteration that was started in October of 2018. And we have 6 investments in there with 5 general partners, and we've invested $283 million, currently marked at $608 million. Then we went to NCL3, and this parallels a commitment we've made to Ares Landmark, where we're able to execute co-investments, diligence with them, and get them to handle the legal execution. So in NCL3, we made 9 investments through March 31st, but then since the March 31st, we've done another 4 investments for $150 million. So in total, so far in NCL3, it's 13 investments with 9 general partners. And through March, $295 million deployed, and that value is $342. So when we look at making these co-investments, we're always looking at downside protection, but then base case returns and potentially what the upside will be. And so we want to try and look at how we've performed relative to expectations. The main tranche or the main series you want to look at is NCL2 because that's the more mature. And you have to factor in that that was also hit by COVID. So that's causing some time delays with impact IRR and also impacted the financial performance of some of those investments. But we're still at a 2.1x TVPI and a 22% IRR. So we feel like we're tracking ahead of expectations for our expected performance. And we've actually seen good realizations. The distribute has been about 30%. However, we've just received a couple more distributions, which puts us right up at about 50% realized there. And if you look at the total value, including the 4 deals we've done through June, we're at $1.1 billion in NAV. And so we've tried to deploy the capital judiciously with vintage diversification and high conviction investments. If you look down at the bottom, what we also did was, well, I just wanted to highlight or show what our expected savings are by doing the co-investments. And we made some assumptions. And if you say those assumptions are reasonable, a 4-year hold, 175 basis point fee and 20% carry, you would see at the end of the day, we expect to save $258 million. And you could say, hey, what's the validity of that? Well, if you look at NCL2, it's tracking for expected returns. So we feel confident that will meet or exceed that.
Good question. Some of these sidecar co-investments have actually performed better than the underlying investment, right?
You mean better than the fund?
Yes. Occasionally.
Oh, yeah.
Occasionally, yeah. There's certain instances where you have the ability to get access to an investment that isn't, say, diluted by a bunch of other investments. But we have one, it's a large one we made an investment in, and we're already at 2.4x. We've already had, we made a $115 million investment. We have $63 million back, and we still have NAV left. So, yeah, this does give us a chance. And we've looked at a lot of investments. So I'd say we've executed on probably only less than 10% of the deals we've looked at.
And these fee savings are not reflected in what we normally talk about in terms of our whole portfolios.
fee savings.
So these aren't in reduced costs. These are costs we've been willing to pay.
Right. Yeah, I mean, it's somewhat reflected in kind of the CEM analysis because these are very low cost investments. So it's in there, not to that extent. That's potential over time. But
And especially going into this time period, if we make a primary commitment, we're relying on the general partner to deploy the capital and to deploy it judiciously. When we went into this recent period of volatility, we said we want to focus on strong free cash flow, resilience of earnings. Lots of times we've been able to find companies where they're contracted revenues, so you have visibility on forward revenues, and it's actually really reasonable multiples. So it gives us the ability to be a little bit more specific in what we want to target on our investments.
Thank you. And it feels like the opportunity set has, besides growing, it's gotten better because in this environment, only the best group, the best opportunities are really going to be funded with debt from a bank. So other things that are so, so it's a much higher quality of opportunities.
The next slide. So the next two slides give some of the attributes or the composition of the program. And to Craig's point earlier, there's an interesting trend we've seen. So if you look at the chart on the left, there's one thing you have to make it a revision for. The yellow is actually the 2019 vintage year, and the orange is the 2022 vintage year. So this chart is just showing you the amount of capital deployed based off of current NAV. And we also look at it for cost. We can't impact how an investment appreciates, but if you look at 2018, we deployed 77 million of capital in two investments, and that was started at the end of the year of 2018. In 2019, we picked up some momentum. We were able to make four investments that accounted for $206 million. And then you'll notice 2020 is missing. You have COVID, so the COVID year really changed things. And then as you look forward, in 2021, this cycle started kicking back in. So we did two co-investments for 48 million. And then in 2022, things accelerated. But that's also where we became cautious and being really selective on the deals. But in 2022, we were able to do 7 co-investments with 6 general partners, and it was 247 million. And the point Craig brought up earlier was that you saw LPs bumping up under allocation constraints, so they didn't have the flexibility to step in and do co-investments. We are about 2 billion under, so we were able to come in, step in, and get access to some of those deals. And in 2023, we've done $150 million of co-investments in 4 of them with 4 GPs. So we've tried to diversify across vintage, and we don't want to be too concentrated. COVID definitely threw off that plan. If you look at the GICS industries, fairly diversified. No real estate, no energy is going to be in here because that's not in our mandate. And then if you look at industrials, that actually captures business services. And a lot of those companies we like, they have contractual recurring revenues, but it's not what you think of as maybe a typical industrial type of company like manufacturing. Next page, the geographic allocation. It's as you would expect, weighted towards North America and Western Europe. That's where our GPs are. We do nothing in Asia as far as individual GPs, but some of our GPs have exposure. And then on the right-hand side, that's the general partner breakdown. So each color represents 9 general partners. So we found diversification, especially given the amount of commitments we've made. And you'll see the 2 blue ones are the lion's share. Well, the one on the left is because 2 of those deals actually performed extremely well. It's NAV. And the other one on the right, we did one really large deal. That's been one of the top performers. And if you look at it on cost, it would look like it's more evenly distributed. And what this shows is the general partners are willing to offer us co-investment when it's available if we're not in their funds. It's a way for us to diligence the GP. It's a way for them to show us what they can provide to us. But it's all with the thought of, guess what? We want to provide co-investment to our existing LPs. This is extra. And so what we try and do is utilize it to get to know the general partner, show them we can execute on co-investment, and hopefully we can leverage that into a primary commitment where we can layer on more co-investment.
Next page. So the cash flows, 11 of the last 12 calendar years, we have been cash flow positive, and distributions have outweighed funding. Second half of this year, it seems like we're poised to have an increase to distributions from what managers are saying. So far through June, that delta, we are cash flow positive. It's only 45 million. However, with things that we know are coming back in the very near term, it should bump up significantly. And actually rolling forward from June to just this past Friday, it's more like 110 million. So I do expect that, again, unless there's some major event in the markets that causes deals to not take place, it's going to be another cash flow positive year for us. However, you can see it's not going to be anywhere near 2021's level or 2022's. I wouldn't expect that. And what we're seeing is actually mirrored in the public markets for the most part.
And really what you want to see with the private equity program is the red and the blue being fairly consistent, because if you're out of vintages, it's very hard to catch back up. Distributions start to far outweigh the commitment. So we really want to try and get capital deployed so that that red line doesn't keep bumping up incrementally. And we get way back.
Next page. All right, so the discussion now isn't our portfolio, it's more of the industry. All right. So this is buy-side activity. That top chart is going to show the transactions that have taken place. And you can see how it's declined 2021 to 22 to 23. Okay, it's only through June of 23. But deployment is down substantially. It peaked in the fourth quarter of 21. Current quarter, call it June quarter, it was down versus that time frame like 49%. Dry powder at the end of 22, that means the amount of capital available to be invested still was a substantial number, second highest, $850 billion, slightly down from 21. But again, I mean, that's a lot of money looking for a home to be invested in. The year could turn out to be a healthy year still, just double the 420, call that, on the far right, the top chart, and you get 840. And if you look back, that could be really the third highest year, but we'll see. Interest rates aren't playing in the favor of having that happen right now.
And I guess what we've seen is the general partners being a lot more discriminating in deploying capital because of all the dynamics going on and where a lot of the activity has been on accretive tuck-in acquisitions. So they've been trying to take advantage of that aspect of the market.
I should say that the top chart is North America. The bottom left chart is North America and Europe pricing. I couldn't find a source that was simply North America alone, but you can see how pricing has come down so far in 2023. And I'd expect that to occur, continuing going forward. The bottom right chart, this is US. This is pretty interesting. You can see the use of debt in getting a transaction done. It's fallen substantially in the first 6 months from what was 51% in 2022 to slightly less than 43.5% of the cap structure. There's a couple of reasons for that. One, debt availability, right? And two, the cost of the debt. The managers are going to have to be a little bit more thoughtful on how much leverage they would apply because of the expense associated with it and also the additional risk that it would entail. Next slide. This is the sell side activity. So basically think about exits. And I mentioned that we were, our portfolio kind of looked like this as well. 2021, a huge year for the industry in terms of exits. And then it started to fall off a cliff. Let's see. So main area where the exits are taking place right now, it's not the IPO market. IPO markets are shut down, even though we saw some things take place over the month or two. It's large corporations buying tuck-in acquisitions. It's setting a record right now. It's approximately 62% of all exits year to date. Last year, it was a healthy number too, at 53%, but the year prior to that, you're talking 30%. So it's stepped up. Now there are fewer exits, but corporates are still being active. Next chart. This is the loan maturity wall. This is that, we've talked about this in the past, how far long ago that we really garnered a lot of attention, great financial crisis. So how to read this chart. The yellow is year end 21, the blue is year end 22, and the green is as of July of this year, right? So year end 21, the amount of debt that was coming due in 2023, far left bar, was $33 billion. Well, there's a couple things that need to be done. Either a manager needs to refinance it or it needs to be sold, like they're going to sell the company. Whatever the avenue was, that $33 billion by the end of 2022 was $7.5 billion. 6 months later, 7 months later, it was less than 3. What's going on? They are able to refinance it. It's more of a struggle. They're jumping on getting that done sooner rather than later. And they're extending the maturities out to, look how 27 and 28 really in particular has climbed. You can see it a little bit more dramatically over the last, call it 2.5 years. But there's a price to pay on that. When a deal was first done, you were looking at call it SOFR plus 575 basis points. So all in at that time, less than 7%, call it 6.5%, even less, 6.5. Today, it's SOFR plus 600. So your all in is more like 11.5%. That's a huge change. So the managers are, if possibly using more equity when they're refinancing it. They are for sure using more lenders. The deal could have been done before with 1 or 2. Now they're talking to 3, 4 in order to get a transaction financed.
And they did this proactively too. So they started and pushed that wall out to 2028, trying to get as advantageous financing terms as they could. So some's being done now, but they didn't wait around for everything to go up and then say, oh, we have to go start doing it.
So that financing cost call it from 6.5, 6.25 all the way up to 11.5. That's for a good company. If it's a company that's struggling in this environment, it's going to be much more expensive. Next page. So the opportunity set. We mentioned NCL 2 and 3 and the co-investments. Well, we'd like to be able to do an NCL 4 as well. That has paid off in spades, and we continue to see good opportunities. So we think it's a nice use of capital. One of the things that we like to do as well is add a complementary strategy to that. What do we mean by that is we're looking at larger transactions. We're missing a piece of the market in co-invest, smaller bite sizes. Things that would be, enterprise value company that's maybe less than $100 million or definitely less than 250. A lot of growth there. We've had a lot of success with smaller managers in terms of their performance. We think we see good deal flow this time in the market. So something to think about. Right.
Any questions?
I was just going to say for the co-investments, the next iteration is NCL4, which we're going to do, want to do with a primary commitment to Aries Landmark that'll enable us co-investment program moving up. And then we've been able to leverage primary commitments we've made, but we also want to use the co-investments to leverage getting access to primary commitments because there's now more availability with a fair number of LPs being up at their allocation constraints. And then we now have 1.1 billion of NAV. So it's a significant part of it. And we've been thinking more about, rather than doing opportunistically, do we set a target allocation for each year to try and be more programmatic? And then on the last point, we're focusing on future primary commitments, always where we can lever on the co-investment, but we want to be with high conviction managers that we would make a primary commitment to, even without investment. And then the last bullet is, a structure that Craig mentioned where how do we get access to those general partners that complement what we're doing directly.
Questions from those that are joining us by phone? How about those present?
Yes, sir.
Thank you for your presentation. And Sean, I'm sorry I wasn't in the room when certain people would call me on the phone. I had to step out and take it. Anyway, welcome, UNCG graduate.
We'll see.
Good CW, yeah. Vacancy program. Now we'll have a public equity section, and then we'll have the public comment section. If you bring the sheet up here, that'd be great. Before we go into public equity, it's important to tell the members what a great job Rhonda and Greg are doing. When you see this first handout, you'll see that we have a vacant position in our trader position and also the analyst position. It's not from a lack of posting. It's not from a lack of interviewing. It's not from a lack of me saying, yes, hire this person. Correct?
That is correct.
And the other analyst position was a personal situation where the spouse was moving to a different part of the country, and that's why that position is vacant. So we continually to work on that, and whether it's Sean or anyone else, it's very important that whoever we do hire fits into the culture of this team that you have sitting out, because they're the ones that work with all day. Sean, congratulations for getting through that filter. I'm not sure I can get through that filter. Actually, I know I couldn't get through that filter. So, congratulations.
Well, thank you. I appreciate that, Treasurer. Hello, everyone. The public equity team, as the Treasurer indicated, currently is comprised of Greg Taylor and myself, and we have over 27 years of combined experience. So, the ball's not being dropped by, small team with a powerful punch here. The Treasurer has been very supportive of our efforts to fill the vacant positions, but we want to be careful about how we go about filling those. We're specifically looking for skilled talent that, is experienced, high performing, committed, dedicated, because these roles, the training and the learning curve can be very steep. So we really want to focus on getting the right individual that can last for the longer haul and can balance that responsibility that we have managing both an internal portfolio and an external portfolio. So I appreciate the effort that some of our internal IMD team has lent us during this period of transition for the team. Thanks Casey, Matt, Chris Morris for just kind of filling in the gap to, allow Greg and I to, when we are off-site somewhere, to kind of fill in for us during those times. And so I do appreciate that. We do have multiple redundancies within IMD to kind of fill in those roles for the short term. So I do thank the IMD team for that support. Okay, next slide. You can go one more. All right, this is our usual snapshot of total equity. Referencing the top left chart, the portfolio AUM as of June 30 stood at 41.9 billion, and that is up from our COVID 2020 period where AUM stood at about 33.4. This has just kind of been fueled by market performance. There's been no additional allocation to the portfolio during that time. In the top right box, you can see that the number of investment strategies now stand at 16. That's down 1 from last year, and that's just a slight change where we consolidated our Russell Midcap and Russell Top 200 portfolios to form the Russell 1000. We're capturing the same universe, just kind of doing it a little bit more efficiently and more cost effectively on there. The lower left asset allocation chart has remained relatively the same over the last year. No big changes there, or over the last fiscal year, I should say. And then on the bottom right, you'll notice that of the approximately 41 billion in total AUM, 58% of our equity portfolio is managed passively, and about 18 billion of that is internally managed. So, that's maintained steadily since the last year. So there's been no material changes there as well. Any questions? If we can go to the next slide. The net of fee performance for the period ending June 30 shows the overall portfolio has outperformed the benchmark on the 1, 5, 10, 15, and 20-year time periods, illustrating that the portfolio has done what it is designed to do, try to maintain risk control, positive performance over longer term time horizons. The COVID 2020 year is still captured and reflected in our 3-year performance across the entire portfolio. And you'll see that, kind of going through some of the other slides as we go through the presentation. Large cap continues to outperform small during this period of time, and growth still outperformed value over the same time period, which allowed our portfolio to kind of lean more into the market's momentum drivers over that outperformance period. The index concentrations remained the same, and there's a thematic theme going on, and particularly the domestic markets where index concentration is concerned. 10 of the top names account for more than half of the Russell and the S&P 500 index returns, and Greg's going to get a little bit more in detail in the next session of the presentation regarding those market concentration levels and the dominance of what is now called the Magnificent Seven. This has replaced the terminology of FANG. So now you've got these small groups that have really accounted for a significant amount of market concentration over the time period, and Greg will talk about that a little bit more. Mega cap technology stocks have also contributed to performance in our international portfolios as AI outlook and optimism has gained momentum, which benefited our portfolio. Developed markets actually outperformed emerging markets in large part due to some of that technology, and then exposures to China underperformance during this quarter has also led to some of the outperformance that we've experienced. Next slide. Looking now at our public fund universe comparison, our domestic equity portfolio ranks in the top decile for the 1 year ending June 30, and it still retains a top quartile rank performance relative to our public fund peers over the longer periods of time. But we're still trailing on that 3 year, and that is because of the underperformance of the 2020 COVID period. Next slide. Our international portfolio, on the other hand, has outperformed on the 1 year ending June, which was largely attributable to the still growth bias that our portfolio maintains. It is competitively in line with our peers over those longer term time periods, but not in that top decile that we've seen in the domestic portfolio. Next slide. Okay, I just want to touch upon just a few portfolio structure observations over the period as well. Next slide. This is just a point in time snapshot that's reflected as of June 30 of what our portfolio geographic exposures look like. We are underweight the US and overweight Netherlands, Japan, UK, Italy, and China. But please keep in mind that these exposures are merely reflecting a fallout of our aggregate manager selection. These are not targeted weightings. We just monitor what these allocations are across our total portfolio, but it is a fallout of manager selection. The political discord in China has resulted in many investors seeking opportunities elsewhere, namely India, who's experienced significant asset flows over the last several years, and Japan, where currency is significantly undervalued, almost 6 standard deviations. So, here you're seeing that as a fallout of the structure, we are overweight Japan, and at that time, underweight the India exposure. But managers are seeing a lot more asset flows going into India, and we see a little bit more of that, but it's kind of just past this last quarter. We probably won't see it on this one, but maybe next year about this time we may see the India number come out of the underweight.
And not to overcomplicate, but if you're in a country where their stock market has gone down dramatically, that in and of itself, through the denominator effect, can create an underweight, right?
That is correct. Next page. From a risk perspective, our portfolio is underweight U.S. markets. From a style perspective, we're overweight growth versus value. Any of this stock-specific risk exposure that's driven, that you're seeing that's driven in our portfolio is largely manager-driven. It is a fallout of manager selection. No targeted weightings on our own, but we continue to monitor that as well. If there are no questions, I'll now turn it over to Greg. He can dig a bit more into the broad market as well as the performance for our internal portfolios. Any questions? All right, thanks.
Next slide, Miss. So as Rhonda mentioned, kind of this year we've seen a return to growth outperforming value. And that's really been driven by those big growth large cap names, with 85% of the difference between the growth and value here being driven by those 6 names: Apple, Microsoft, Nvidia, Amazon, Tesla, and Google. And that's kind of gone back to the trend that we've seen for the past kind of 10 years. But last year was kind of the first time where we saw that reverse and value actually outperform growth. Next slide. There's just a little more detail on that. You can see over both the 1 year and year to date, top performing style is growth and large cap stocks, with the worst performance coming from yield stocks and quality stocks. This has kind of led to the cap weight index becoming the most concentrated it's been since the 70s, where the top 10% of names account for almost 70% of the index. So, it's kind of a trend we've been seeing continue this year. It's just those big names keep performing to outperform and thus become bigger and bigger portions of the benchmarks.
Artificial intelligence has certainly helped to buoy those names significantly.
Next slide, Matt. So now just looking at the performance of our internal portfolios, see since inception returns remain strong. Two index funds have very low tracking error, just modestly outperforming by a couple of basis points since inception. And then the bottom one, the core factor portfolio, you see that that's underperformed over the 1 year, given that portfolio is kind of overweight those value and quality names that haven't done so well this year, but since inception still outperforming the benchmark. So far so good with that one.
Yeah, I think it's a good chance to reflect on that. It wasn't that long ago we didn't have those programs at all, and we were having trouble getting it off the ground and everything. So I think a lot of credit. You see how successfully that's all been implemented and how we've expanded it beyond just what was initially going to be there. So, kudos to Rhonda and Greg, as well as Casey. I know did a lot of work on that too. And he's gone to the real estate pastures now, but it's a great work by the team on that. Just a job well done.
And I don't want to discount the fact that, that internal U.S. core factor strategy, it was literally born internally. Greg's developed that strategy, and it was with the intent of trying to kind of lower our exposures over time to those top heavy names in the index, and really try to kind of, lessen that volatility for our portfolio and create a little bit more diversity. So, hats off to him. Like I said, we're a small team, but we're still kind of digging in, diving deep, and trying to figure out how we can continue to create or generate cost savings for the plan and outperformance as well.
So I'll just add quickly on that one. You see the Russell 1000 inception dates June 2022. If you remember, kind of we initially launched with the Russell 200 and Russell Midcap, which then got rolled into that 1000, but we started with those in November 2017.
And Jeff, just for the record, could you state your name and position?
Jeff Smith, co-CIO.
Thank you.
And for the person who formerly used to bring us brisket.
I'm going to get in there.
I want that in the record.
For the record.
For the record. And just to add, before we go to the next slide, that everybody's absolutely correct. My first day here was January 1st of 2017. They were on a long runway to stand up this internal management division. And we put them on a big goal, short deadline, and they launched it in November of that year, just a few months after I got here. So that would not have happened without Greg and Casey and Rhonda making that happen. So credit to you, and I don't think those that teach, protect, and serve will really know the true value of what you've done over the last several years to make this happen. It's something truly to be proud of. So.
Next slide. Thanks, Matt. So just
So this next slide was a 0.
Yep.
17, this was a 0.
So yeah, looking at the trading activity for the year, you can see we traded just over 38 million shares for a total value of around $3 billion. This was lower than last year, given now that we're managing to the 1,000 turnover around those reconstitutions is much lower. So that was kind of one of the reasons for doing that, is just reducing some of the trading costs and operational needs. And so just looking at the reconstitution from June of this year, you can see turnover was just under 5%, trading around 9 million shares. last year that was significantly higher. And the last slide, Matt. So yeah, just looking at total AUM for the internal passive accounts, you can see as of June, we're just over 18 billion, which is a record AUM level for the internal passive. And this chart just reflects the consolidation of the 200, the mid cap now just in that 1,000.
Is it safe to say for my public purposes that the 18 billion is over the 115? It's not over the total amount that you manage? There's nothing, is there anything in the 18 billion that's not in the pension system?
No. If you have any questions,
Any questions for?
Just a comment, the almost 26,000 orders is just that's just incredible. You got a machine.
All of them but one went really well. Just kidding.
It's always the one they talk about.
Greg has had to seek some therapy. He's in the egg raising business now with chickens. So that's how he gets his mental health from 20,000 trades. Is partnering with his wife on that venture. So it's a great venture. So anyway.
All right, well, I mean, we thank you for your time. We had a good quarter. Great time to come before you, but you know, we're not fooling ourselves. I mean, we've got volatility still, and you know that there are going to be periods where you know performance is not going to be so great. But just know that we're continuing to push forward. You know, maintain consistency in the portfolio, control the cost, control the risk, and you know, and hopefully start to turn things around and get some longer term performance as we move ahead. So thank you.
Thank you for doing such a good job.
Yes, thank you.
All right.
Any questions from the phone, Lance or Mike Madden? Hearing none, we'll now thank you all for your remarks. We're now going to go to our public comment section. Jason's going to give us a brief update. We have Justin, Matt, and Jessica who are going to be speaking. And Jason, I think some of these people have spoken before, so you're familiar with the rules. Glad to have you. I'm not, is our friend left?
Yeah.
I was on mute, Treasurer, sorry.
Well, the friend's on mute, but somebody can tell her the comment I made. The cries of a child rather than the snores of the audience. So
She loved it.
So I hope she heard that. So, and what a blessing. So we'll start by giving the housekeeping.
Okay, and just for anyone else beyond those three that were named, if you would like to make a public comment, just ask you after the meeting to sign the public comment sign-up sheet for our record. And this is in addition to our attendance sign-in sheet. For the public comment, commenters are provided generally 3 minutes. I will time you and give you a 30-second warning. And with that, begin public comment.
All right, we'll start with Justin. Welcome.
Good morning, everybody. So, and I've been here before. My name is Justin Flores with the Private Equity Stakeholder Project. And me and my colleague Matt were here and spoke at the February meeting about some concerning housing issues going on within some of the firms that are in the NCRS portfolio. And after that meeting, we had what we thought was a productive first conversation with Treasurer Falwell and appreciated that with the staff. However, when we followed up to continue to discuss those issues afterwards, we were ignored. And so we understand that Treasurer Falwell and the staff care about these issues and are in dialogue with the private equity firms about them. And it certainly makes sense that certain information needs to remain confidential for various reasons. But we believe in dialogue with constituents and ordinary people and not only with the wealthy private equity companies. And so while they and everybody else deserves a voice, you can imagine that private equity firms that are often coming here asking for hundreds of millions of dollars may not be the most forthcoming with information about their practices. And so while their voice is necessary, we also believe it's important to engage with diverse viewpoints before making any policy decisions. And as NC residents and taxpayers and retirees, we really feel like our elected leaders should be willing to meet with us about these issues. Dialogue's always a good thing, even when, and maybe especially when, there's disagreement. And so in this sense, we're disappointed that we haven't been able to continue that dialogue with the treasurer and staff. But want to be clear that, we really believe, and we think it's a sort of objectively fact, that there is a housing crisis in the state, driven at least in part by the increase in corporate ownership in real estate. And this body is using retiree money to invest in some of these companies that are increasing private equity ownership of housing in the state. And so we think that it's important for there to be a policy for investments that ensures that retiree and taxpayer money does not fuel housing costs and problematic property management for retirees and taxpayers. And we think that's a logical step toward addressing the current housing crisis. So we had sent the treasurer and staff a list of principles that we hope that will be adopted.
30 seconds.
That will, that can ensure those corporate owners of housing are meeting minimal requirements before receiving money from retirees. Things like just cause for eviction, reasonable rent increases, no excessive fees, recognizing and negotiating with tenant organizations, among other common sense investments that we think that they can adopt if investors make it clear that these are important measurements. So again, thank you for your time and consideration on these issues, and sincerely hope that we can work together to ensure that the retirement system is never in a position of fueling a housing crisis here in the state or elsewhere.
Our next speaker is Matt. Welcome.
I'm going to try and be as eloquent as Justin here, but we'll see. Hi, y'all. I'm Madeline Bankson. I research housing and private equity stakeholder project. As Justin mentioned, we've been to IAC meetings in the past, and we're trying to start a discussion around the impacts of the state's housing investments. But with these efforts so far being more or less unsuccessful, we feel compelled that we need to draw attention to how NCRS's investments and private equity, landlords specifically, are harming tenants throughout North Carolina, and to call the treasurer to adopt the principles for responsible investment for any future investments that are used to acquire housing here in North Carolina. It's a fact that North Carolina has a corporate landlord problem. Large investors here own over 40,000 homes, and in addition, firms are buying up apartment complexes and mobile home parks, resulting in steep rent increases, junk fees, inadequate maintenance, and problematic eviction filings. Some of these rental companies are owned or backed by private equity firms that receive funding from this board. For one, NCRS has invested over $2.6 billion since 2017 in Landmark Partners. We've talked about this before. This is a major investor in Progress Residential, the largest single-family rental company in the U.S. They have over 7,700 homes in North Carolina. No other pension fund has invested more than $500 million during this time period. Furthermore, since 2012, you've also invested $3.8 billion in the private equity firm Blackstone, which previously owned the single-family rental company Invitation Homes and currently owns the problematic rent-to-own company Home Partners of America. We've also invested $300 million in Brookfield Asset Management, which owns Ginkgo Residential. Ginkgo has more than 5,700 apartments in North Carolina. Last year, they bought a building in Kernersville and immediately gave notice to the existing tenants to vacate their below market rate apartments. This is hardly surprising behavior for Ginkgo. Between February of 2021 and February of 2023, they filed 393 evictions in Durham County alone, making it the county's fourth largest evictor. Many of these filings occurred during the federal eviction moratorium. We understand that y'all have a fiduciary duty to serve your pension fund recipients, but most of those pensioners are themselves working people whose economic stability relies indirectly as well as directly on your investment choices. This is part of your fiduciary duty. I'd like to read a quote from Karina Soni, a community member who's a librarian at UNC. She writes, Due to life changes, I had to move homes. Moving is already bad, but it was made awful due to North Carolina's housing situation.
Seconds.
Homes that I could afford last year were double the price they were a year ago. I'm a state employee. Not being able to afford a place to live in the community I serve every day feels like a sick joke. I'm disgusted that the state is using my retirement savings to worsen the situation for me and other public workers. NCRS needs to adopt principles for future investments to ensure that those investments will not negatively impact North Carolina residents. So we have a list of these conditions that your asset managers should agree to in order to receive future commitments, and I'll distribute a handout that's outlining these in detail. We look forward to discussing with y'all how the state pension board can help to be a part of building a North Carolina that is livable and affordable for retirees, public employees, and tenants more broadly. Thank you. I'm happy to take any questions. Thank you.
Our next presenter is Jessica.
Hey guys, it's nice to see you in person. So my name is Jessica Moreno. I'm a housing justice organizer with an organization called Action NC, and we have a national tenant association called Renters Rising. And so we are part of many organizations that fight for tenant rights. Most of my base are renters that rent from corporate landlords or other apartment complexes. And a lot of what I hear is the rent is going up every year. I can't contact my landlord. They don't answer the phone. I call 800 number. I get a different person every time. I have to do my own repairs in the home because the requests get denied or they get pushed back. And so these are issues that, how does that in your position affect you? Well, your job is to make sure that the fund is healthy and it's making money, right? But I think we have to look at this issue in the sense of we need to make sure that the residents of North Carolina are also healthy, and housing is a big part of that. And of course, like Justin and Matt mentioned, we have some guidelines that we've developed that we think for future investments, we would love it for you all to adopt, because housing is a major issue. Housing is a major issue, and people are, there's a lack of housing, and corporate landlords are buying the housing that are available for first-time home buyers. And so people are stuck between a rock and a hard place. And we know that most people can't make it here. People are working or kids are in school now. And so it takes a lot of effort to bring the community to these type of meetings. And so we appreciate the opportunity to talk in front of you guys, and for you all to listen to what's really going on. But we do need further discussion because this is something that's affecting not only Charlotte, Mecklenburg, Raleigh, Durham, Greensboro, Winston-Salem. These are pockets of places where there's a lot of investment going on. And I do believe that there are ways, in my most humblest and ignorant standpoint, right, to be responsible with the investments that we make as a state, and still be able to have a healthy fund for our pension recipients. And so, yeah, I appreciate you guys, and I hope that you all take into consideration the things that we're saying.
3 seconds.
Thank you. Thank you for coming. We'll now close the public comment section and go to our board members who are joining us remotely to see if you have any comments or questions from staff or regarding.
Thank you, Mr. Treasurer. This is Mike. Appreciate the work that goes into these meetings every quarter. I don't have any questions. Thank you.
Thank you. Greg?
No questions, sir. Just want to compliment the staff on another job well done.
I agree. I think that this year's looking better. We just hope it continues. Thank you.
And Lance? Before I close, I just have one clarifying question and one remark. Public comment section's closed. We've met some of the folks who have come before us in the past. And at every turn, this staff, myself, including the people who greeted you in this building, have treated you with radical hospitality. So I don't know what your definition of the word ignore is, but that's not my definition of ignoring. Um, Number one. Number two, I can tell you that every word that you've ever uttered, we don't listen just so that we can respond. We listen to understand. Not enough of this in the world. We listen to understand. We don't listen just so we can think of something to respond with. Thirdly, unless my memory is leaving me, any characterization that we have $2.7 billion in these types of investments, I think that we'll be providing you some information that we do not have $2.7 billion in investment specific to the issue that you're here for. I think you know that, but it may not fit your narrative. But we're going to get you that information so that you are crystal clear about what we own and where that money is. The last couple of things I will say is that you can't look at what someone's wearing or how they look or what their resume may say and think you know their life. So these things that you're discussing are things that I grew up in. And that blood continues to run through me. Lastly, one of the 20 hats that I wear in addition to this one is on the North Carolina Housing Finance Agency. I'm almost shocked that when you talk about affordable housing, when we're dealing with the employment crisis of people not being able to get jobs in these urban areas because they can't afford to live close enough to their work with their gasoline at $4.50 a gallon. I get it. I get it all. And I'm just kind of surprised that with the state agencies that actually deal with the financing of low-cost housing, that I've never seen your group participate in any of those meetings because I'm on that board also. So it's just a suggestion. If you really want to actually attack a problem, that might be a direction that you might want to look into. And I do know, as a citizen of Winston-Salem, and a 65-year-old person who grew up in this situation as a kid, I do know that there are lots of other types of governmental entities that have a responsibility for actually trying to positively affect this topic. I'll also add the name of a person that you've heard of before. His name is Erskine Bowles, a very successful public servant, former president of the university system, former chief of staff to the president of the United States. He has a program that I'm very fond of that you probably should research, where he's tired of the bureaucracy as it relates to affordable housing. So he has set up an entity in Charlotte, which you should investigate, that actually gets wealthy people to put money in funds. But this whole idea of calling it a nonprofit is not solving the problem. The people who put money in these funds through this program, I think they get a 5 or 6% return on their money. And I encourage you to investigate that, because what they're doing to actually capture properties, fix things that I had to grow up in my childhood with, whether it's insects or water or whatever it is you want to talk about in terms of the living conditions. And I highly encourage you to do that, because they themselves are tired of the bureaucracy of all this money that's going toward this issue of affordable housing, but nothing was getting done. So I highly encourage you to look at former President when you're the president of the university system, you're always called the president, to really look at the program that they've implemented in Charlotte, including pictures, including acquisition prices, including what they've done to upgrade the facilities. I'm speaking as a person when I'm speaking to you about this topic. I'm also the chair of this board, but I'm speaking to you as a person of things that I've actually seen, not just to respond to somebody, but an effort to understand what's really going on. As I close, I want to thank all of the staff for putting this together and make this jump up on the table. I want to thank the investment management team, who I compliment and brag on, except for the Bristol's comment. I want to thank you for what you do to advocate for the invisible. We have 1 million people on this pension plan now. 1 out of 10 adult North Carolinians is on this pension plan. Can you believe that, Lars? 1 out of 10 adult North Carolinians. I used to say that if you want to know why I act the way I do, and my wife has said, I've known you long before you were the state treasurer and you acted that way then, so you can't blame it on being the state treasurer. That was humor. I'm sorry it wasn't funny to you. But it was funny. Okay. Chris laughed. Thank you, Christopher. But if you want to know why I talk the way I do and say the things I say, when you have 1 out of 10 adult North Carolinians who are depending on these pension checks, and now there are less people paying into the plan than are not, it's serious business. There may be some of our guests here who are on this pension plan. And I dare say, not knowing you, that behind your faith and behind your health and behind your family, possibly the 2 most important things in your life are things that come out of this building, which is the pension and the state health plan. And we take that very seriously, and this staff takes that very seriously. And so I appreciate what this staff does to advocate for the invincible, whether it's these suggestions that are going to be left with us or anything else. I appreciate the effort going into that. As you've heard me say many times, what we do here is we're in the check delivery business. Most of those checks are blessings. Somebody gets a job, we'll say a local government, they retire from a job. The females in the room, they're probably going to get more retirement checks than paychecks because your life expectancy is doing pretty good these days. The males aren't doing so well. Most of those checks are blessings, but unfortunately, some of the things that we have to do around here on a weekly basis are not blessings. And those couple that were brought to mind last week one was the 1-year anniversary of Wake County Deputy Ned Bird, who was a participant in this plan. And a person my age has been to a lot of funerals. But until you see a K-9 officer jump up on the casket of her owner during a funeral service, until you've seen that, you really hadn't seen much. The reason I'm saying this to you is that sometimes in the grief process, unknown means unloved, which means if you didn't know Deputy Bird, that means you kind of forgot about all this. What you should also know is that Sasha, who was always by Deputy Bird's side, was in the back of the car when he was murdered. So this is the first time Sasha had been back with its owner since this murder had happened. And during the service, jumps up on the casket. So we keep the family and friends in this community, Wake County Sheriff and his department, in our prayers as we have acknowledged the 1-year anniversary of his burial. And also last week, a corrections officer who was driving to work one morning and came around a bend when it was still kind of dark. A family, from what I understand, was walking either in the middle of the road or close to the edge of the road. Struck a 17-year-old boy. Never saw him. Killed the 17-year-old boy. While this state employee stopped his vehicle, got out of his vehicle, was trying to attend to the medical needs of this teenager, the father pulled out a gun and murdered him, and then stole the truck. So my point of saying this all to you, which seems a little bit out of context for an IAC meeting, is if God is love, why is there so much hate? Well, that's just pure hate. So bringing this full circle, being in the check delivery business means that most of the checks that we deliver are blessings. But unfortunately, those that are killed in the line of duty or lose their life while in service in some way, shape, or form, those are not blessings at all. And lastly, school has started. So it's time for eyes up and phones down. Because when you think about the concept of grief, that unknown is unloved, you have to imagine just for a split second that the possibility of the person who's riding that school bus, boarding that school bus, or getting off that school bus is somebody that you might be really connected to. So I'm taking every opportunity this week, as I have with the Governor's Highway Safety Commission, Commissioner Causey, Superintendent of Public Instruction Truitt, to draw attention in any way, shape, or form that I can, that we're all into our routines. We're not going to have a discussion about my routines, because that would take like 5 hours in this meeting. But we're all into our routines, and we have not been in the routine of seeing yellow school buses on the road and people getting on and off school buses. So as I close, I'd like to close in honor of the 1-year anniversary of the burial of Deputy Byrd, our state employee, Mr. McGee, I believe this was his name, who was murdered last week, and to remind all of our citizens that as it relates to these school buses, eyes up, phones down. So with that, I'll entertain a motion to adjourn.
I'll humbly make that motion.
Second.
Motion second being made. Any further discussion? Hearing none, the clerk will call the roll.
For the roll call, Mr. Annarella? Mr. Brewer?
Aye.
Mr. Mevin?
We're adjourned. Thank you very much.
Good seeing you, sir. Have fun in Ireland with 40. How long?